What is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms. Today, I've got my co-host here, Kyle Ryan, as always, and we have our second guest. We'd like to introduce everybody to Cayden McLaughlin. Cayden is a friend of the pod, but also an enrolled agent, kind of running his own tax preparation practice. And we really wanted to have him on as kind of right around this time is tax filing, time of the year. And we also just wanted to hit on a couple of things that we've been talking about offline as far as just some key points to really understand when it comes to taxes, and things to recognize as you're moving maybe in a W-2 job or thinking about considering maybe going to a 1099 self-employed status. We're also going to kind of talk about the difference between marginal and effective tax rates. Now, a lot of people don't necessarily know what those two words means, but Cayden's going to kind of help explain those two differences. And then we're also going to talk about bonuses. This is a conversation I've had with clients here very frequently, as a lot of bonuses are paid out in February, and how bonuses might get taxed a little bit differently than most income. So, just kind of wanted to intro Cayden, what we're going to talk about today. Kyle, would love to just kind of get your thoughts on the conversation.
Yeah, Cayden, thank you for joining us. I have to throw a disclosure note out there that, we're not, we're not recommending Cayden services endorsing was the word I was going for, endorsing Cayden services by any means, but Cayden's here to help us from an educational perspective, explain a lot of these different topics, walk us through it in layman's terms. And a really good spot to start off with, Cayden, if you can give us some insight, is in your experience now as a tax professional, as an enrolled agent, what are some of the benefits that you've seen for clients working with you versus maybe they were self-filing earlier, some things that you can pick up on?
Yeah, Thomas, Kyle, thank you for having me. Greatly appreciate being on the podcast again with you guys.
Yeah.
And you're right. We're kind of in the middle of tax season. A lot of people need to get the tax returns done by April 15th or March 15th if you're self-employed with an S corp. And so, what I would say that you see like a lot of TurboTax, you see a lot of self-preparation, and I think kind of the misnomer there is that it's just a lot of data entry, and that does play a significant portion of tax preparation. However, I think where the benefit of working with someone is just kind of making sure, because as you two know, the tax code's constantly updating. It's changing every single year. There's new regulation, there's new contribution limits and guidelines for credits, and just having like a professional that works in the industry that understands what these changes are and how they apply to your individual situation, and can also kind of help you navigate the complex waters of tax planning and kind of think about it, not just in terms of what the current year liability might be, but, how is this going to model 1, 2, 3, 5, and 10 years out? Are we trying to minimize tax liability across the board cumulatively, or just kind of hyper-focus on the current year? And that's really where the benefit of a tax planner or preparer comes into play.
Yeah. And I think, questions I always ask people, or at least I'll highlight when it comes to the opportunity of working with a professional, is a lot of the time, that professional is asking questions that, that specific person might not even know is available, or they don't even know what they don't know. And I think that applies to, both pieces of our industry. And I also think that just having a second set of eyes on a return can be really important if a mistake is made, but also with how complex some of the software is getting as well. I've got a client that we inherited, that I actually have been working with, here over the last couple of weeks on a specific situation that's directly reflected on this conversation. Is she's retired now, she's a self-filer and doesn't use software. So she does everything manually, which is crazy as a young person to me, but that's how she likes to do it. But she retired at the end of 2021 and was making Roth contributions in 2022. Now, software most likely would have picked that up, but because she paper filed and she wasn't necessarily working with a professional, we had to work to get those 2022 Roth contributions recharacterized and sent back to her so that she didn't incur a penalty on the filing for next year. And so just kind of working through things like that are so important. And I think you kind of really highlighted, what the advantages are for, working with a professional. in a really quick manner.
And just carrying on the topic of doing it manually, self-filing via the paper and mailing that in, there's so many different ways to make a mistake, right? The calculation of taxable Social Security, that's where I see the number one mistake made for people who are writing it down. The good news about, the softwares is that, like you said, it will pick up on those, like, hey, you made too much for a Roth contribution last year. This is how much of your Social Security is taxed. So it takes a lot of the heavy lifting off your plate.
Yeah. Yeah, absolutely.
That's impressive to me, to do it by paper manually, because there's just so much intricacy involved, and there's so many different complex situations and factors to take in that, by using software, even if you are going to self-prepare, using software is kind of a good fallback. It's not foolproof, but it gives you a little bit more reassurance that you're dotting your I's, crossing your T's, and you have all of the boxes checked and filled out that you need to. I think my fear would be, if you were going to self-prepare manually, that if there was a mistake, you would have to amend it. And that could add 6 and 9 months onto the process to hear back from the IRS. And I wouldn't wish that on my worst enemy.
Yeah. Yeah. Absolutely. And so kind of like diving into today's conversation, on top of what we just talked about, we kind of wanted to give, a quick explanation, at least from you, to get a quick explanation on something that we talk with clients about often, especially when it comes to retirement planning. But also in the current year, focusing on your taxes, is a difference between marginal and effective rates. Because what I think people understand on a general level is that the U.S. federal tax system is a bracketed system. So in general, the more money you make, the higher the possibility that you'll be in a higher percentage tax bracket. But can you kind of describe to people the realities of that graduated system, and how you're kind of pouring into buckets at certain points of time with your income?
Yeah, absolutely. This is, you're spot on the money there. This is a big misconception that I see often with clients. They think, oh, I'm in a 24% bracket and I'm going to pay 24% on every single dollar that I make. And that's just not true. Our United States tax code system is a progressive tax system. And so you're only paying that top marginal tax rate on any dollar that falls into that bracket. Now, when you take your smallest bracket, the 0%, the 10, the 12, the 15, the 20, so on and so forth, you're going to get the average, which is your effective tax rate. That's really what you paid in actuality, across all of the different brackets. But when you're in, say, like a 24% marginal bracket, you're only paying 24% on every dollar above, the lower brackets involved. So only every dollar that falls into that specific bracket gets taxed at 24%.
Yeah.
Why this is so important right now, like if we, there's a lot of clients kind of getting ready to retire, baby boomers, they have a lot of pre-taxable retirement assets in their nest egg, and we're looking at options to do like a Roth conversion of some sort. And so, clients, I think the misconception there can be, well, I don't want to do a Roth conversion right now. I'm already in a 24% bracket. And it's like, well, if we actually break it down and look at it, your effective bracket is only 17%, or your effective rate is only 17%. And, everyone's different. Everyone has their own belief systems. But I think when you kind of make that distinction, you'll see that clients are a little bit more willing to engage in those types of conversations, because they understand, hey, I didn't actually have to pay as much as I thought I did originally.
Yeah.
I've also seen that work against a recommendation. Well, why would I pay a marginal rate of 22% if my effective rate's only 15? And then you have to do real tax planning and saying, okay, well, this is where you are today. This is where we estimate you to be in the future. And in the future, in some circumstances, you'll never be below 22% marginal rate. So do the Roth conversion today. But yeah, I mean, it's, you just see a percentage there. You always want to go with the lower number, but I always try and put a lot more emphasis on the marginal tax bracket, what your next dollar is going to get taxed at, rather than the effective.
Yeah. Yeah. And that's even where advisors will differ, is which tax rate you're kind of focusing on there. Some are in your camp where they're marginal, some are in the other camp where they're focused on effective. And that's just where even, from advisor to advisor can be different. And, kind of moving on to the next piece here is kind of this misconception in general that people would prefer a refund, a tax refund versus maybe owing a little bit in taxes. Can you kind of tell us what your experience has been there, and kind of the idea of giving an interest-free loan to the government is what a lot of people say about getting a refund where you're overpaying and then getting a little bit back in the future. Can you kind of give us your take on that?
Yeah, so I think one of the most common things that I see is the idea or notion that if you get money back, you get a tax refund from the IRS, that it's a positive, it's a good thing. And if you owe money at the end of the year to the IRS, it's a bad thing, it's a negative. And, I'm not necessarily sure that those are equivalent sort of things to make. I don't necessarily see a refund as a positive or a negative. I don't necessarily see owing money as a positive or a negative. At the end of the day, owing taxes is a function of making money. So if you're going to make more money, you're going to owe more taxes. Really, from a tax planning perspective, we want to make sure that we're withholding enough, that we're not going to be caught off guard or have a big surprise at the end of the year with tax liability.
Yeah.
We also don't want to be incurring any underpayment penalties. So, also not just a matter of making sure that we're withholding enough, but that we're getting it over to the IRS on a quarterly basis with those deadlines that they have. Getting a refund, I wouldn't want to see a client get too big of a refund. As you were mentioning earlier, what is that effectively? It's effectively you made an interest-free loan to the IRS. You let them borrow money from you, and then they paid it back at the end of the year. But from a perspective of, daily expenses, daily liquidity, if you got a $5,000 refund from the IRS, is that $5,000 that you could have used throughout the year for, a vacation or towards an investment account or whatever the personal situation is? We want to try to get as close to what the actual amount owed is, whether that's a little bit over or a little bit under, but we don't want you to get a massive refund, because then that's money that you could have been doing something else with.
Yeah, absolutely. I think, kind of a hot take here is I think people love getting a refund because in general, most people don't have very good cash flow. They're terrified of owing because they don't think they have enough cash to pay it when tax time comes. And, I think that, and just instilling an ideal in your life of just having good tax planning where you're not having a large refund or a large, owing a large amount, is just trying to be kind of even keel and balanced in how much you're paying on an annual year, to make sure that you've paid enough, but you're not paying too much, to get that huge refund.
It all comes down to psychology at the end of the day, right? Some people don't mind owing, right? As long as it's not above a certain amount. Some people want the refund because it's their vacation fund, right? We always go on vacation in July. So when my refund comes in April, that's like the down payment.
Yeah.
And as you mentioned, Cayden, I don't mind if it's like a small amount marginally, but if you're in like the $5,000-$10,000 refund range, then you're leaving some money on the table. And I'm glad you mentioned the payment penalty, because it's not a black and white thing how much you should really withhold unless you're trying to get a set amount at the end of the day. But what you don't want to do is you don't want to pay, call it point blank, stupid money, penalties. If you can avoid paying penalties, then you're whole, right? Even if you owe or you get money back, at the end of the day, you're going to get back to, the mean of what you were supposed to be at. If you owe because of penalties for not paying enough, that's a shame. That's just money wasted down the tube. And, we never want to see that. It happens far more often than we would like, especially, and we'll get into this topic, but with self-employed individuals, it can be a little bit more difficult to withhold the right amount versus W-2, where it's automatically calculated for you.
Yeah, and let's transition there actually. Just kind of talking about the difference in tax planning, or just at least tax flow, between being, a W-2, a salaried employee, versus being, a 1099 self-employed individual. There's a difference in how taxes are being withheld. And, Cayden, I'd love to just kind of have you walk everybody through what kind of the prime differences are and maybe some things to look out for.
Yeah. And so, as Kyle was just saying with the penalties, I was just about to transition here as well, where I tend to see most of the penalties come into play is with self-employed individuals, 1099 income people who, maybe realtors or, commission only jobs, whatever it may be. And what it comes down to is it comes down to those payroll taxes, right? So when you earn money, we have payroll taxes. It's going to be a portion to Medicare. It's going to be a portion to Social Security. Across the board, it's going to add up to 15.3%. Now, when you're W-2 and you work for your employer, half of that is considered payroll tax and the company withholds it on your behalf. And then the other half is what you owe for Medicare and for Social Security. And that's going to be withheld every paycheck as well. But when you're self-employed, you don't have the employer withholding that 7.5% on your behalf. And so what happens is that you're going to owe self-employment taxes at the end of the year. I think that right there is kind of, a red flag or something that trips up self-employed individuals. They don't realize it until the end of the year that maybe they should have been moving this 7.5% over into a different account for tax purposes to pay it at the end of the year. And then they get kind of caught off guard with a large tax liability. Yeah. And so, it's going to come down to, again, making sure that you make those estimated payments. There are some ways to kind of set up accounts to keep it a little bit more organized, and that way you're not caught off guard. But really the estimated payments, quarterly payments, even if you're not entirely sure what you owe, sending the IRS some money and minimizing those underpayment penalties is far better than waiting until April to pay everything all at once.
And as a 1099 employee, like W-2, each time you get a paycheck, automatic withholding based on single, married, how many kids you have, X, Y, and Z, right? But with 1099, you might get a paycheck, but it's not automatically withheld from unless you set it up that way. So if you wait and you're making money from January 1st to December and you don't pay until April, doesn't matter. You have to pay them as you go. The IRS wants money as you go, not just all at once, because like we mentioned before, they're making interest on that money. They want the present value of it early on. So you can't just wait until the end of the year, do it all at once. You have to pay as you go. And that's why you mentioned the quarterly estimated payments. They usually want to see you make those payments quarterly.
Yeah. Exactly. And I would say make sure, and especially if you're in a state that requires state taxes, make sure you're paying the state as well. Kyle, I know you're based out of Florida, so you guys don't have state income tax. But me being in Kansas, we pay state income tax. So just making sure you're doing state as well. But it has been so interesting in my career, seeing 1099 individuals, so self-employed people, not even knowing that they have to make quarterly estimated tax payments. It's something that I think is not necessarily taught or talked about very often. But if you transition to a 1099 job, you start your own business, even if you have a side business, right? I think this is becoming much more frequent, is, having a side business. If you're earning income through sales, revenue, profit, whatever it may be, on a 1099 basis as a self-employed individual, you've got to pay those estimated federal and state taxes if the state taxes apply to you. Making sure you're doing that. One of the things on the W-2 side that I really wanted to, Kyle, you brought this up, that I really wanted to hit, that I see very often with young people who are starting families, is they forget to update their it's a W-9, correct, Kyle, on a number of dependents. So if you go from married to having one child, you need to update your W-9. If you have a second child, update your W-9. Even if you're single to becoming married, you got to update your W-9. A lot of people won't do that. And that's going to, inaccurately withhold the amount of money in taxes that you should be according to your current state. I think that's really important.
Yeah, we've seen it plenty of times. You're paid, the people administering your paycheck, they're going to withhold the amount that thinks that your income, they're going to set you up on your taxes. So if you're married, they're not really looking at your spouse's taxes. So sometimes you have to play with the exemption amount to make sure you're withholding the right amount. But W-2s, I think of W-2 income as like easy filing. You get a W-2, you punch in what's in the boxes, see you later, done. 1099s, that's where more often than not, I recommend that they work with a tax professional, because you not only have to do bookkeeping to get all of your income down, but you have to write off all your you know, applicable expenses. You have to account for qualified business income deduction. You get to write off half your self-employment tax. So like there's all these different things that go into the self-employed, you know, benefits of being self-employed. But unless you're aware of them and accurately accounting for them, then you could be hurting yourself.
Yeah.
And the thing that I would add there too is we're kind of in a unique situation. You know, since 2017, we've been under the Tax Cuts and Jobs Act. That is set to sunset at the end of 2025. Now, nobody has a crystal ball to know if the Treasury is going to come out and kind of maintain that tax code, switch it to something else, or do something entirely new. But as it stands today, we're going to revert back to what it was prior to 2017. And so, you know, since 2017, it's been quite advantageous to stay with the standard deduction. But we've also seen a whole boom and swoon of new businesses and self-employed individuals since the pandemic. And so they might not be entirely cued into itemizing their deductions and going through that because the standard deduction has just made so much sense as of recently. But, you know, making sure that you're looking at what your mortgage interest is, what your real estate taxes are, any medical expenses above 7.5% of AGI, adjusted gross income. You know, there's a lot of advantages to making sure that you have a good paper trail and a good record trail of all of your itemized deductions, because while it might not make a huge difference today, it's a good practice to have that, because maybe tomorrow or next year when you file, you know, the regulations might be different and you might need to do something a little bit different with how you prepare.
Yeah, I think that's such a great point on the documentation side. Is regardless of your tax status, whether you're W-2 or 1099, keep an adequate record of any sort of documents that come into play with expenses that you incur. And what I mean by that is make sure that you're keeping all of your mortgage payment statements. Make sure you're keeping all of your health insurance bills, statements, copies, whatever it may be. Try and really build out a folder and a file for that. So if you need to lean on that, you can, because there's so many times where I find people needing a document and they don't have it, and it takes forever to find it, or they got to track it down, make a bunch of phone calls, emails, whatever it may be, and trying to do that. And the second thing I'd say from a bookkeeping perspective, as a self-employed person, get software. Do not try and rely on paper receipts. If there's anything that I've learned with working with the tax professionals that I've worked with, but also with the business owners that I do serve, it's you're going to make your life infinitely better. And just, it's going to be more efficient and effective to have bookkeeping software to track transactions, to categorize deductions and expenses and things of that nature.
Yep.
I agree with that. And, you know, just from a perspective of you guys, certified financial planners, being an investment advisor and trying to be a fiduciary and have your client's best interest in mind at all times, by being able to kind of have your client also have a tax professional involved, and you can work with that tax professional to kind of solidify what the best path forward is for the client, that's a lot of value. You know, there's a lot of intricacies across all planning and the entire financial planning sphere. And, you know, when as a client, it gives you a lot of peace of mind when your advisor and your tax preparer are on the same page. One of the worst things I see that happens quite frequently is that, you know, your certified financial planners looking at it from how do we minimize taxes cumulatively over your lifetime, but the tax preparer is looking at it from how do we get your biggest refund right now, this current year.
Yeah.
And when you work together and you have those two parties on the same page for you, the client, I mean, that's just going to be a win-win for the client 10 out of 10 times.
Always. Two heads are better than one. And, you know, two different sets of eyes could be looking at the same thing, but through different lenses, like you mentioned.
Yeah. And last thing that we just want to mention real quick, because I know we're kind of running up on some time here, is bonuses. So especially with W-2 individuals, what I've had to walk through people, at least on a general level, through a lot on bonuses is they know they're getting the bonus. They know how much the bonus is, but when the bonus check comes in, they realize that that bonus check is not necessarily taxed at the same rate that they may be used to with their traditional salary. And Cayden, I'd love to just kind of get your take and your thoughts on bonuses and some things to kind of realize if you have bonus potential at your job.
Yeah, so bonuses are going to be taxed at the supplemental tax rate. It's generally a little bit higher than what most median individuals would be withholding on their W-2. It's about 22% is the supplemental tax rate. And, you know, I think kind of the misnomer is like when you get a bonus, mentally, you've already spent it before it even hits the account. And you're like,
Yeah.
I'm getting a $10,000 bonus and I'm taking a $10,000 vacation. And then you get the bonus and it's after, you know, the 22% has been withheld and it's not necessarily 10,000 or whatever it is. It's quite a bit less. And so just kind of having the mentality of, you know, not spending in excess, making sure that you're, you know, spending what the after-tax amount would be. What I personally love about the bonuses, yes, they're taxed at a higher rate, but I always found those to be great for like retirement contributions where, you know, maybe you're on your regular W-2, you're withholding whatever up to the employer match would be. But this way you're able to kind of use a little or contribute a little bit more by using that bonus money. That's where I see the best benefit of it rather than spending it mentally and then actually getting a little bit less after tax as a result.
Yeah, absolutely. Perfect. Well, that kind of sums up the episode today. Kyle, do you have anything else?
No, that was good.
Perfect. All right. Well, hey, Cayden, thank you so much for coming on today. We really appreciate your time and your experience and your education here. If anybody has any questions or thoughts on this episode, please feel free to reach out to us. Our social media sites and emails are linked here on our YouTube page. Also, if you're seeing this on LinkedIn, feel free and reach out to us as well. We will tag Cayden in the LinkedIn post, his profile on this, if you're ever looking for a tax professional. So feel free and do that as well. And just want to say thank you to everybody watching or listening or doing a little bit of both. And we will see you next week.